What makes Millennium more than 2 times better than its competition?
Millennium has $69 billion in assets under management. I think they've only had one down year. What they were attributing that to in large part was their very tight stop losses that they have. And stop losses is just another word for risk limits. If a portfolio manager is given $1 billion worth of capital, if they lose $50 million, they get a tap on the shoulder. They might cut that portfolio manager's capital allocation by 50%. And if they were to lose an additional 25 million, they might get fired altogether. Let's say you made $1,000 investment and you lost $75. That's like kind of a crappy month in the markets. That's it. You're out of a job. That's a very tight stop loss. And one of the metrics on which capital is allocated within these firms and the performance of those returns are then measured is something called the Sharpe ratio. All it is a measure of how much you return over the risk-free rate. If your money was just parked in an overnight money market fund, whatever you were able to return above that through your investments, let's say that risk-free rate is 5% and you return 10%, okay, your excess return is 5%. What's that over the volatility of the actual investment itself? If you divide your 5% excess return by 2% volatility, you look like a hero. If you divide that 5% excess return by a 20% volatility, you look like a moron. It's like jumping on a mechanical bull and clinging on for dear life. According to the article, the average peer of Millenniums has a Sharpe ratio of something like 1.1. 1, good. 2, better. 3, best. You want a higher Sharpe ratio, given the math that I just walked you through. So it said that Millennium's Sharpe ratio was reported to be 2.6. So more than double the average of its peers.
And just one more data point. I think the S&P Sharpe ratio is about 0.3.